Welcome to Discovery Watch with John Kaiser.
I'm your host, Jim Goddard. Welcome back to the show, John.
Jim, pleasure to be back on Discovery Watch.
John, defense metals hit a new high yesterday. What was behind that?
Well, the Financial Times, the British publication, had an article on Tuesday about inquiries the Chinese government officials have been making about what would be the impact of a Chinese export ban on rare earths on European and American manufacturers, and in particular U.S. defense contractors who make the F-35 fighter jet. Now, those were kind of fighting words, and the market jumped on it and said, oh boy, here we go again, rare earth mania 2.0, the same thing as in 2010-11 when the dispute over the Senkaku Islands with Japan led to China withholding exports of rare earths to Japan and elsewhere in the world. And it was a bit of a mess because the Chinese operators who controlled the rare earth supply ended up hoarding it and then smuggling it. And we saw rare earth prices go up 10 to 30 times in price. And that ultimately was a bit of a disaster for everybody, including the Chinese. So for the Chinese, the real purpose of this was to force more manufacturers to shift their production of technology components into China so that they can more effectively steal the intellectual property associated with these rare earth-based technologies. And this indeed happened. Companies, they wanted to make sure they had rare earth supply, their inputs for their products that they were making. So they moved their operations to China. And of course, the inevitable happened. Somehow the knowledge seeped out into Chinese operators. And now there are Chinese manufacturers making these same technologies that Western companies had helped transfer into the Chinese possession. And that's part of the big unhappiness these days about Chinese theft of IP from Western innovators. Now, this time it's a bit different because the situation, it doesn't really lend itself to shutting down the exports. The market kind of thought, oh, these government officials are singling out the U.S. defense contractors, but the military uses a fraction of the global rare earth annual supply. Most of the rare earths are used by commercial applications, and so you would have to ban exports to all of the world to actually deny the U.S. military access to critical rare earth inputs for its own military technologies, because they, of course, would just go through a third party and procure a subset of what the car maker is importing from China to make its motors for its electric vehicles, and the Chinese would not be the wiser as to from whom and how the military is getting what little rare earths it needs for its own applications. So that was all a big fuss about nothing. But it was interesting that the Chinese officials would float this idea, guaranteed to stir the pot. And the reaction across the board has been, why would they do this? What's the purpose of this? It would ultimately hurt them. But I think the issue is more the problem that's showing up in the tension between the United States and China over Taiwan. Now, a really big problem is Taiwan and its role as the base for semiconductor manufacturing. The best chip makers are all based in Taiwan, and the world relies on chips made in Taiwan. Now, in 2019, the main company started to raise possibility of building a facility, a foundry facility in the United States. But that will cost billions of dollars and take multiple years to happen. When COVID hit last March, the Taiwanese chip makers did shut down operations, but because Taiwan was so effective, they were able to start up again relatively quickly, and there wasn't really any chip shortage because Western manufacturers had to slow down or even suspend their manufacturing in order to deal with the pandemic. But very strangely, in the last quarter of this year, chip shortages have materialized, even though this is the wrong season for this to happen, forcing some car manufacturers to suspend the production of certain model lines because they don't have the chips needed to run all the different parts in a contemporary car, which is ever more electrified as we go forward. And what's emerging is that when the COVID crisis hit, people realized that just-in-time procurement strategy is not the greatest thing. And the last 15, 20 years has all been about globalization, making possible just-in-time strategies. You secure it from the lowest cost jurisdiction. It ultimately became the basis for much of the populist unhappiness in the past decade that did lead to Trump becoming president in 2017. It is the realization that globalization is reversing itself. And when the COVID crisis hit, this became very clear. There's a lot of talk now about diversifying supply chains to not rely on a single concentrated supply chain. It's becoming part of the ESG narrative that if you are thinking strategically for the long-term welfare of your shareholders, you must build some redundancy into your supply chains. And it appears that this year some manufacturers got the memo about this and others didn't. And those who got the memo have been stockpiling chips, buying them in advance and hoarding them for later usage, which has created something of an artificial shortage for those who continue to do their just-in-time procurement strategies. So those who thought it was business as usual, those are the ones that have a problem. But why are companies so eager to shift to stockpiling their critical inputs for their manufacturing capacity that's based, say, in the United States? Well, the problem with Taiwan is that China claims that it is still part of China, and the United States has had this diplomatic dance for the last 40 years where it kind of pretends that that is the case, but still acknowledges Taiwan as an independent nation, and it is a democracy as opposed to China being an autocracy. And during the Trump administration, that diplomacy was dialed down a bit, and the United States became more overtly supportive of Taiwan as an independent nation. And this is very important because if you have the nation's chip-making capacity based in Taiwan, you do need Taiwan to not become like Hong Kong, which is very clear now, is now just another part of mainland China. The financial sector, yes, it can pack up and move to Singapore and carry on all its financial wheelings and dealings. Hong Kong will just become this, glorified city that's part of mainland China. But you cannot pick up these foundries. And part of the background problem is that the technology war that Trump initiated with China when he became concerned about Huawei and its 5G technology possibly becoming a way to spy on Western infrastructure and activity and perhaps even undermine it. He introduced bans on certain chip technology, U.S. technology going to China, and one of them was the technology that goes into these foundries to make chips, so that this technology cannot be transferred to China. So with something like a rare earth, that's a generic product. It's very difficult to control who it gets sold to. But when you have technology that is owned by somebody by virtue of the intellectual property, it is very easy to control whom the manufacturer delivers it to. So China has had a bit of a problem dealing with this blockade of technology going into China even on commercial terms. So this saber rattling with regard to the rare earths, I believe it is linked to this technology war in the background and also linked to increasing tensions with regard to the future of Taiwan. Because if China does make a move to annex Taiwan, what does the United States do? Well, it suddenly becomes a very high-level, intense confrontation, and in that case, shipping of goods back and forth from the United States to China would cease completely. That also would mean the world's rare earth supply would evaporate because China wouldn't be shipping this to anybody. Now, going all this way is not something that's smart for China because it would end up turning itself into something of a hermit nation. It could also escalate into a military confrontation that would not be good for anybody. But China has made a major step in the past year after it let the COVID crisis get out of control and then brutally got it under control with with the measures that an autocracy is possible. Its stance with regard to the rest of the world has shifted. We call this the wolf warrior stance, where all of a sudden China is far more aggressive with regard to the rest of the world. It is pushing back. It is saying, we will own the future. We're not going to sit back and bide our time. And the rising, tension between the United States and Canada, which Biden cannot reverse because it's become clear that this is a battle between autocracy and democracy, with the United States, despite the January 6th Capitol Hill fiasco, is still a democracy. And so the tension will continue, and the risk is there that something will go wrong, some mistake will be made, and there will be an out-of-control escalation into a military confrontation. So thinking hard about where your raw materials come from, in particular rare earths, has become very important. And in January, the Chinese also put out for comments proposed changes to the way rare earths are manufactured and refined. They're trying to get it more under control. The electric vehicle fleet build-out is escalating a lot faster than anybody imagined 4 or 5 years ago. This recent decision by GM that it will not produce internal combustion engines after 2035, that makes the shift almost irreversible. So the likelihood is high that total rare earth demand in 10 years will eclipse what even China is able to supply. So there's also strategic thinking on China's part. Where are we going to get our own rare earths from? And this particularly applies to the heavy rare earths, of which it also has only a finite supply and would actually have solid reasons to limit exports so that it has sufficient available for domestic consumption. But the problem with the Chinese rare earth production is that the government subsidizes it by allowing very low labor and health standards and emission controls in their production, which creates a very low price, what you might call the dirty China price, against which other jurisdictions in the rest of the world cannot compete because their cost structure is going to be a lot higher. So China has to figure out what it's going to do about this. And the rest of the world is realizing we can't rely on Chinese rare earth supply for these multiple reasons. We need to develop our own. And stocks like MP Materials, which hopes to have Mountain Pass back in production by the start of next year, that it has over a $5 billion valuation. Defense Metals, which has an option to acquire the Wichita light rare earth deposit in British Columbia, it hit 75 cents, and this is a 3% light rare earth deposit, which could be a significant supplier of the key magnet materials, neodymium, praseodymium. These stocks all went up because this is more publicity for this important crisis coming of not enough supply to equip all the future electric cars that are going to be made, but also what happens if the big power battle between the United States and China gets out of control and rare earth supply ceases to flow to the rest of the world.
We'll have more with John Kaiser right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Value from success, growth in discovery. Golden Arrow Resources is a well-funded gold-copper exploration company with proven management and prospective properties in Chile, Argentina, and Paraguay. Golden Arrow trades on the Toronto Venture Exchange, symbol GRG, on Frankfurt, symbol G6A, and the OTCQB, symbol GARWF. For more information, visit us at goldenarrowresources.com or call Sean at 778-686-0135.
Welcome back. We're speaking with John Kaiser. John, last week you told us NioBay Metals was about to start a drill program at its James Bay niobium project. Now it isn't happening. Why is that?
Jim, this is a result of a series of unfortunate events. NioBay originally hoped to start work on building a trail, a winter trail that tracks the Wheaton Winter Road from Cochrane, which is the sort of place that the sort of a staging area for northern Ontario to which roads go. And the Wheaton Winter Road is meant for residential use only. The people from communities such as Moosonee and Moose Factory, they drive up and down into Cochrane to get supplies. Commercial shipments all go via the rail, which also tracks this corridor. But the Wheaton Road is not to be used for commercial shipping. And NioBay had been told, you do not use this road to bring your drill rig up into the James Bay project. You know, they signed the protection agreement. They said they're all fine with that. And NioBay hired a local contractor, meaning somebody that the Moosonee community was familiar with and trusted. But because of the warm weather that we have had in Canada during January, they were not able to get this trail really going on January 15th as they had hoped. It got started much later when that polar vortex, which is now terrorizing Texas, when it came south and finally brought really cold weather. So the contractor was in a hurry to get this trail built, which tracks the Wheaton Winter Road, so the drill can get to the property. And it was about 90% done, at which point the drill crew that was supposed to be doing this was getting antsy. He says, when is the drill going to be here? We have lots of other work to do elsewhere in Ontario and Quebec. This is the winter drilling season. Others don't have this problem of bringing a drill rig in. And then word got around in the Moosonee community that somebody was using the Wheaton Winter Road in a way that was not intended. And so all of a sudden there was, what is NioBay doing? I mean, we had this protection agreement. They agreed to follow our rules. And it turned out that the contractor, in an effort to get the job done quicker than was possible because of the delayed start, was hopping onto the Wheaton Winter Road to move his equipment along and build this trail that was just supposed to be done parallel without ever touching this Wheaton Road. And this turned into a huge kerfuffle. There was a lot of recriminations. NioBay was simply trusting that the contractor was doing this, was not like riding shotgun, making sure that everything was being done according to the protocols that had been designed. And then this resulted in enough unhappiness within the Moosonee committee and with the lateness of this program, the drill crew like complaining that we don't, where's our drill? They decided, okay, we're apologizing for this. We're pulling the plug on this. We are deferring this program. We are not starting this 12,000 meter drill program in winter. There's some unhappiness in Moosonee as some of the people there were hoping to be part of the work crew, but they'll be able to get this going in the summer. What it does as a negative thing for the stock is the PFS, they hope to have it by the middle of 2022. Now it's probably not going to be ready until the end of 2022, a 6-month delay. There is a bit of a silver lining to this. They wanted to do this 12,000 meter infill drilling and a bit of exploration drilling during winter because that's, of course, it's cheaper and more efficient to do it when the ground is frozen. But they're also looking at the possibility of expanding the operating rate from 6,600 tons per day to maybe 50% higher, maybe even 100% higher, double that rate. But to be able to do this and still have this a long-lived mine life, they need to know that this thing extends at least substantially deeper than the 300 meter for which both the underground and open pit mining scenarios have been designed in that recent PEA. If they're going to double the operating rate, the mine life would not be 30 years. It would end up being maybe only 15 years. And that's not something a community like Moosonee wants. They want a long-term job situation that can support the community long term. So as part of going in there in the summer and perhaps extending it right through winter, getting everything worked out, all the protocols in place, they may be able to do additional scout drilling, which ends up establishing that the deposit is substantially bigger. The deeper portion wouldn't become part of the pre-feasibility study because they don't need that, but it would allow them to be able to see that in the long run, when they've depleted the open pit portion, they can go to underground mining, and in 20 years, the autonomous underground mining technology will be so advanced that the people in the Moosonee community would be able to operate this equipment from a nice, cushy office on the site and not have to be down underground blasting stuff and operating equipment, moving ore around. It'll all be done remotely through technology. So it was a bit of a setback in the market. I had published a report on Monday explaining why the stock should be trading in the $3 to $6 range just based on the PEA assumptions and its billion-dollar outcome. I think the stock, as soon as people realized that this was not a breakdown in the relationship between the Moose Cree First Nation and NioBay, but that it was a result of corners being cut, emerging from other headaches that were weather-related and so on. And it's been patched up, and there'll be a cooling off period, and I'm pretty confident that everything will be on track in the summer. And while it sets back the timeline 6 months, it also enables the company to perhaps get more done during the drilling program, and they have from the government a 20,000 meter permit, and they were only going to use 12,000 meters of that. So a little bit of a setback, but it is not a drastic breaking in the relationship between the Moose Cree First Nation and NioBay Metals.
We'll have more with John Kaiser right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Aben Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Aben's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at abenresources.com.
Welcome back. We're speaking with John Kaiser. John, whatever happened to the Fisher joint venture between Tigga Gold and SSR Mining?
Jim, I first introduced Tigga Gold to Discovery Watch back in early 2019 based on the Fisher joint venture, and I last talked about it in May of last year. Now, the flagship project is called Fisher. It's a 40-kilometer long property in northern Saskatchewan, which Eagle Plains staked to cover the Tabinor Fault, which is a deep-seated crustal scale structure that runs for 1,500 kilometers all the way into the United States. The name Fisher has to do with the prospector who had checked this all out and realized that in this particular area, shearing has taken, which makes this type of crustal scale feature very good for delivering orogenic vein gold deposits into the adjoining cracks and structures. And when SSR acquired Claude Resources in early 2016 for $500 million, it acquired both the CB and Santoy mine infrastructure. There is still ore left, but there wasn't a huge amount of ore left. And that same year, a few months later, they did a deal with Eagle Plains to option up to 80% of the Fisher property, which required them to spend $4 million to earn 60%. And once they had done that, they had a 1-year option to elect to go to 80% by paying an additional $3 million. Now, obviously, 20% net interest is not a huge percentage for Eagle Plains to take. They know that SSR, if it is able to delineate reserves on the Fisher joint venture property to feed the Santoy mill when it runs out of ore from its own property, that it would want to own 20%. And Eagle Plains has been a multi-decade prospect generator, which has done spin-outs, very successful spin-outs, several times. So in early 2018, they spun out the Fisher joint venture and several other properties in the area as a new company called Tigga Gold on the basis of 1 Tigga Gold for each Eagle Plain share. And that's when I started covering the story in early 2019. They had already had several years of work. Now, the odd thing was SSR spent its $4 million, but didn't pull the plug and say, we have 60%. Each year, they ended up spending more. In fact, by the end of 2020, they had spent $12 million drilling 87 holes for about 34,000 meters. And they did not have a huge amount to show for that work. That's a huge amount of money to be spending on carefully understanding 40 kilometers of a shear system, mapping the geology, testing it to see what the controls are. But fortunately, by the end of last year, the Mac North zone had evolved sufficiently that they could see that, yes, this hangs together. We can build a resource out of it. Now, last year, because of COVID, they had to interrupt the program in March, and they did not resume it until September. And then there was further uncertainty created when SSR and Kaiser Gold decided to do a merger of equals. And then it turned out that the CEO of Kaiser would end up becoming the CEO of SSR with Paul Benson, who had been the CEO during the 3-4 years of the Fisher JV option. He was leaving, so there was uncertainty as to what would happen. Well, in November, the company finally declared to Eagle Plains that we have vested for 60% after spending $12 million. So that then created a situation. Okay, now we have to wait a year for them to make a $3 million payment. And during that period, they weren't going to be on the hook for any money that SSR was going to spend. But there was also the uncertainty is maybe they'll do nothing in all of 2021 and decline to exercise the step-up option and then announce a $10 million program for 2022, of which Tigga Gold was supposed to fund 40%, come up with $4 million that it didn't have in order to participate in a program operated by a major who was going to put out quarterly reports and definitely not design anything for to boost fundraising opportunities. So that was the bit of the nightmare that we were looking at heading into 2021. But on January 5th, Tigga Gold got a New Year's present from SSR. They wrote a check for $3 million. We are now at an 80-20 joint venture contributing of the next $10 million, Tigga Gold would have to contribute $2 million, with the $3 million payment on top of the $1 million they had in the treasury. They've got $4 million working capital, so they are well positioned to participate, to pay their 20% share. And SSR has indicated that it wants to spend 2021 delineating the MAC North Zone, put together a resource so that the bean counters upstairs can see, yeah, for the $16 million we sunk into this project, plus whatever we do in 2021, we do have high-grade future mill feed. We have a huge database on the project, which was done during the prior 4 years. It looks like there's lots of indications of gold smoke. It will require a lot of work and effort to stitch together other zones, but it looks like the Fisher JV was a smart investment. It will keep the CV Santoy operation alive for many, many more years. Now, what does this mean for Tigga Gold? Well, at 20% and 110 million shares fully diluted, this implies about $100 million valuation for the project already, and there is no resource there yet, and who knows how big it will be at the end of this year. So what's the upside for Tigga Gold? Maybe it grinds to 40, 60 cents. If they're lucky, for each 20 cents, that's an increase in $100 million valuation for the Fisher JV. They do have the Leland project farmed out 75% to another junior called SKRR Exploration, but that's again a similar situation. But they do have the Orchid property, which is about 70 kilometers south of Santoy. It also straddles the Tabinor Fault. It has evident that they've got gold showings in there in the past. And as the JV partner, the Eagle Plains team has been able to look at all the work done on the Fisher joint venture. It has given them new understanding of what makes these shears related to the Tabinor Fault tick, as they are now considering going in with a winter program on the 100% owned Orchid project, and apply all that knowledge that basically SSR paid for with the $12 million it spent. And they could, if they're fortunate, they could deliver the discovery with an initial drill program based on all this knowledge if they decide to go ahead with the program. And the valuation of Orchid is only $20 million. So getting a 5-bagger would put the valuation at $100 million. So the company is finally in a shape where the asset that it has with the Fisher 20% interest, that's plodding along under SSR's mining's efforts, and now it has enough money to go and mount an initial program on the Orchid project, which if it delivers a discovery hole in the current bull cycle that we are in for resource juniors, they should be able to add to raise additional money. And if this all starts to unfold, SSR may very well say, we need to get rid of this company and own it 100% right away, because obviously Orchid would be of benefit to our Santoy mill also. So things finally looking up for Tigga Gold. The story makes sense, and we will continue to watch it on Discovery Watch.
John, thank you so much for the update.
You're welcome, Jim.
We've been talking with John Kaiser, his website kaiserresearch.com. I'm Jim Goddard.
Comments made on Discovery Watch are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Discovery Watch is a production of How Street Media Incorporated.